Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. Big news week this week. We chatted a little bit about it on the Loonie Hour, so highly encourage you to go check that out. But kind of want to bring that conversation back to, again, what this weekly Saturday video focuses on, which is the Canadian housing market, because there's a lot of pieces that are happening behind the scenes. So we had the Federal Reserve, the U.S. Federal Reserve, the most important central bank, obviously raising rates by 75 basis points, the single largest rate hike since 1994. So it's not very often they come out with a 75 basis point banger, but they did. So 75 basis points there. And what you're starting to see is really these cracks emerging as the U.S. dollar strengthens, as this highly levered global monetary system, as all these over leveraged sovereigns start to face rising interest rates. You're left with this issue, and this is what coming back to the core thesis of this video and my Twitter and whatnot is like, you really can't normalize interest rate policy, right? Like, it becomes hard to fight inflation. Now, again, they're certainly trying, and they're going to push as hard as they can until something breaks. And like I said, I think that you clearly watch markets and things are breaking. All you have to do is look at what's happening in Japan, right? They've got yield curve control, so they basically say, well, we don't want yields to go over 0.25%. We will basically buy as much Japanese government bonds as we need to in order to suppress those yields from going up and the cost of borrowing obviously increasing. And so what's happened is they basically have been forced to buy an increasing amount of Japanese government debt in order to keep the yields down, the interest rates down, and thus by doing so, they've been weakening their currency, right? As everybody else offers a higher rate of interest on your capital, capital basically has been fleeing Japan, and so you have the yen. Japanese yen is now at a 24-year low against the U.S. dollar. And then keep in mind, Japan is one of the most important central banks out there. They're one of the largest economies out there. And then you go to the Eurozone, which in Italy, you basically have a highly leveraged society there, huge amounts of sovereign debt, and so their yields are spiking. I think the yields on Italian debt is around north of 4% now, and so the ECB, the European Central Bank, has had to come out and say, well, we're not going to call it quantitative easing, but we're proposing an emergency meeting of emergency segmentation, they're calling. I don't even know what they're calling it, but they're basically trying to anti-fragmentation tool. Sorry, is what they're calling it, an anti-fragmentation tool. So again, don't call it QE, but we'll call it something else. And if it walks like a duck and talks like a duck, it's probably a duck. So these are the predicaments. They're almost going to be forced into quantitative easing despite 8% inflation. And keep in mind, interest rates in Europe are still running at negative 0.5 with inflation at 8. So it kind of just shows you the realities out there. But this isn't going to change the immediate term path for the Bank of Canada. In fact, the immediate term path is, again, higher interest rates, thinking, the economy can handle it, households are fine, et cetera, et cetera. And so the immediate path is a 75 basis point rate hike from the Bank of Canada. They're going to follow in lockstep as the U.S. Federal Reserve did. And so right now the markets are pricing in about a 90% odds of 75 basis point rate hike from the Bank of Canada July 13th. So this is going to have a couple more interesting ramifications because what we're seeing in the market, right, like depending on, again, we don't necessarily have a national housing market. I think that each market can be segmented, but clearly we're seeing a substantial slowdown in housing activity, not just in Vancouver and Toronto, but this is happening at a national level. And so, if you look at sales, they are decelerating, and you got a situation where a lot of these purchases that are still transacting in the market are still basically are on rate holds, and they're locking in these mortgages at 3 or 4%. So a lot of these borrowers are not actually subject to current mortgage rates, which are running about 5.2% today. So you have to keep in mind, again, a lot of people that are closing and making purchases right now are doing so on the premise that they're borrowing at 3%. I just had a couple clients this week close in the threes. And so you have to say, okay, well, what does that look like after the summer months once all these pre-approvals then expire? The market will be subject to basically those 5% fixed rates. Now, what's important to also understand and unpack that a little bit further is that if you're a home buyer right now and you say, hey, you know what, like I'm a little bit nervous about interest rates, I'm going to lock in a 5-year fixed mortgage, despite 5-year fixed mortgages being at 14-year highs. Probably not the best time to be locking in duration on that term, but that's neither here nor there. But you decide to go and lock that in. Well, you've got to qualify now at about 7.2%, right? Because the stress test is your contractual rate plus 2%. So people are basically saying, well, I got to qualify as if the rate is 7 and almost 7.5%. So just to give you an example, if let's say you're a new first-time home buyer, you're earning $90,000 a year, which I think in Canada is not an unreasonable salary. $90,000 a year, qualifying for a 5-year fixed term. So in January, you would have qualified for about $500,000. Today, you qualify for $415,000. So you've lost nearly $100,000 worth of your purchasing power. Simply because rates have gone up and that stress test, that hurdle rate has increased. So now if you shift gears back to the Bank of Canada and their 75 basis point rate hike, what people are basically doing to get away from that mortgage stress test is they're saying, well, why don't I go for a variable rate mortgage? I can pick up a variable today about, let's say, 3.3%. That really puts my stress test at about 5.3. Now, again, remember the stress test is your contractual rate plus 2% or a minimum of 5.25%. So whatever is greater. So basically people are essentially being stress tested at 5.25%. So you have more and more people going variable, and this has regulators getting a little bit concerned. There's some chatter at OSFI, the Canadian banking regulator. They might have to change the stress test around variable rate mortgages. But when the Bank of Canada raises rates 75 basis points here coming up in July, that's going to put your variable rate mortgage at about 4%, which puts your stress test from 5.25 to 6. So we're going to have a continued slowdown in borrower purchasing power. Now, again, I think affordability levels were already stretched. We obviously, there's a phenomenon in Vancouver and Toronto, or particularly a lot of young buyers, a lot of young families are having to get parents to co-sign on mortgages in order to get over that mortgage stress test hurdle rate. So the question really becomes is, what is the appetite for parents to co-sign in this environment? And it's just becoming harder and harder to qualify. So something's going to have to give. And again, I think that over time, that's going to be prices. And that really brings us to, the next point, which is, the national housing market. As we talked about earlier, sales are beginning to slow. The sales to new listings ratio on a seasonally adjusted basis has now dipped into a balanced market territory. Now, again, this is not to say that all of Canada is this way. I think the two hardest markets being hit are Ontario and BC. And you have more stable markets in Alberta, and you actually have rising prices. You still have rising prices in parts of Nova Scotia, for example. So not necessarily all in one, but I think these markets will eventually all slow in unison. That's certainly what we're seeing from the national level. And so, we've now got prices as well decelerating from the highs. Again, they peaked out at about 30% on a year-over-year basis. National home prices, actually, the home price index peaked out at 31%. So the all-time record high for national house price acceleration was 31%, and we're now decelerating. So we'll start to see. But again, you won't see year-over-year price declines in Canada until sometime in 2023. But we are seeing month-over-month declines. In fact, we had our second consecutive month-over-month decline across the national housing market, but very modest declines. You're talking about 0.5% each month. You start adding that up, and it's really not a whole lot. But again, these home price indexes tend to be lagging indicators. So that's kind of how I'm looking at things here. I think that the pressure is on for central banks. I think things, and when we talk about on the show, things starting to break. I think things are already breaking, but the pace of that breakage is starting to accelerate. I mean, Again, we've talked about it on the show before, but the amount of wealth destruction, right? There's no question that central banks are engineering wealth destruction in order to slow inflation. AKA, if you make everybody else poor or more poor, they have less money to spend, aka less consumption, less demand in the economy, which should hopefully allow supply to then build and put some downwards pressure on pricing and inflation. And so, if we look at it today, you've got nearly $15 trillion of wealth destruction, which certainly dwarfs the nearly $10 trillion of wealth destroyed in the 2008 global financial crisis. So this has been a fast pace of wealth destruction. Obviously, there's still lots happening in the crypto markets, but I think one last thing to sort of wrap it up here as we move forward. So I think the near-term outlook, again, nobody has the longer-term outlook crystal ball for the Canadian housing market, but the near-term for the Canadian housing market is it's more pain, it's weaker demand, it's sustainably higher rates around the 5% range, it's rising variable rate mortgages as we head into the summer, and we will get that another rate hike from the Bank of Canada. I think after that, again, it becomes a little bit more murky, where at some point we're going to trip something off, and these central banks are going to be forced to go like this. And I think, again, we are already starting to see that not only from the European Central Bank, but also from the Bank of Japan. So again, that's not to say that rates don't stay at 5. I think the question is, how long do rates stay here at 5%? I think so long as they do, that it's going to allow inventory to build and put some downwards pressure on prices. But one thing to keep in mind is we might be seeing very early days of a potential peak in the 5-year fixed mortgage rate. So you'll see what happened this week. Again, we talked about this in the show before, but the volatility in the bond market is rather extreme right now. So if you look at that 5-year bond, Canada government bond, that thing ripped this week about 30 basis points, ripped all the way up to just north of 3.5%. And it actually came off quite aggressively back down to about 3.3. That is a huge move. I mean, bond markets should not be moving like that. That might be, that decline, that 20 basis point decline, might be the market now sniffing out and saying, okay, central banks are actually doing their job. They're actually aggressively raising rates. And by doing so, they're going to kill demand. They're going to kill the economy. And so the bond market may be starting to price in lower growth and a recession in the very near future. So that's why your Canada 5-year bond, I think, began to slow and roll over towards the end of the week here. Maybe markets have finally got the messaging from central banks, which is they are going to crush the economy, and we are nearing slower and weaker growth ahead. So again, there's a great chart here just to wrap this one up from David Rosenberg from the Economic Surprise Index, which historically has been a very strong indicator of slowing economic growth. So I'll leave that with you. That's what I'm watching here this week. As always, we'll see you next week.